The purpose of this video is to provide an explanation of the solution for Rent&Dent Limited, which was completed as an IFRS 16 assignment. Before we look at the scenario provided, we first go and look at the required in order to determine what information we need to focus on in the scenario. Required A, calculate the interest rate implicit in the lease between Rent&Dent Limited and Rentals Galore Limited in accordance with IFRS 16 leases. Note, round calculated percentages to 3 decimal places. Right, now from the Facebook Live from last week, you will remember that the interest rate implicit in the lease is always calculated from the perspective of the lessor. Requirement B, calculate the amount at which the lease liability will initially be recognized by Rent&Dent Limited on the 1st of January 2010 in accordance with IFRS 16 leases. Note, round calculated amounts to the nearest rand. Right, so the initial recognition of the lease liability, we need to calculate the present value of the lease liability, and that is calculated from the perspective of the lessee. Requirement C, calculate the amount at which the right of use asset will initially be recognized by Rent&Dent Limited on the 1st of January 2010 in accordance with IFRS 16 leases. Note, round calculated amounts to the nearest rand. Right, so the initial recognition of the right of use asset, they want the cost of the right of use asset. And then D, prepare the general journal entries, including cash transactions, of Rent&Dent Limited to account for all transactions for the period 1 January 2010 to 31 December 2010 in accordance with IFRS. Note, round calculated amounts to the nearest rand. Journal narrations are required. Closing journal entries are not required, and journals must be dated. Now that we have a good idea of what we need to do in order to answer these requireds, we can now go and read through the information. Rent&Dent Limited, a company that does business in the vehicle industry, has a 30 April financial reporting date. On 31 December 2009, the company entered into the following rental agreement with Rentals Galore Limited to lease a specialized panel beating machine. 6 monthly lease installment payable in arrears. First payment on the 30th of June 2010 of 75,000 Rand. The lease term is for 5 years. The lease deposit paid on the 1st of January 2010 is 50,000 Rand, and the commencement date of the lease is the 1st of January 2010. The contract is a lease as per IFRS 16. Rent&Dent Limited's internal legal representative, who earns a gross salary of 2,600 Rand per hour as an employee of Rent&Dent Limited, spent 5 hours in order to draft and negotiate the contract. Rent&Dent Limited also incurred initial direct costs of 5,500 Rand related to this lease agreement that were paid to the company's external legal advisor. This fee was paid on commencement date of the lease. In terms of the lease contract, Rentals Galore Limited retains ownership of the machine at the end of the lease term. No option to acquire the asset was granted by the lessor to Rent&Dent Limited. The machine is of a specialized nature and only panel beaters can use it without major modifications being made. The economic life of the machine was 20 years on the 1st of December 2009 when it was initially purchased at fair value by Rentals Galore Limited. Between the date of purchase and the 31st of December 2009, the machine was not taken into use as Rentals Galore Limited purchased the machine with the purpose of leasing it out. The fair value of the machine on the 31st of December 2009 was 1,085,000 Rand. The lease contract specifies a residual value guarantee of 960,000 Rand. If the fair value of the machinery at the end of the lease term is less than 960,000 Rand, Rent&Dent Limited will pay, as part of the final payment, an amount equal to the difference between the estimated fair value of the machinery and the 960,000 Rand. On commencement date, Rent&Dent Limited estimated that the fair value of the machinery would be R950,000 at the end of the lease term. Rentals Galore Limited incurred no initial direct costs in respect of the lease contract, and Rent&Dent Limited has knowledge of all of the information provided above. Additional information: ignore all tax implications. The incremental borrowing rate of Rent&Dent Limited on the 31st of December 2009 was 12% per annum. It is the accounting policy of Rent&Dent Limited to account for machinery in accordance with the cost model of IAS 16, property, plant and equipment, and to depreciate the machinery on the straight line method with an estimated insignificant current residual value. Rent&Dent Limited, a company. We will first look at requirement A, which asked us to calculate the interest rate implicit in the lease. Now we know that the interest rate implicit in the lease must be calculated from the perspective of the lessor. So first things first is we know that lease payments are made 6 monthly. Therefore, lease payments are made twice a year. So first thing you need to do is you need to set your financial calculator to 2 payments per year. Once you have done that, we can now go and fill in all the other variables. So N represents the non-cancellable lease term. The lease term is 5 years, but payments are made twice every year. So you take your 5-year lease term and you times it by your payments per year being 2. The present value is the fair value of the asset given up, and the fair value of the asset given up was R1,085,000 on the 31st of December 2009. But importantly, we know that the lessee paid a deposit on the very first day of the lease of R50,000. If the lessee paid this deposit of R50,000, the lessor does not have to finance that amount. Therefore, the present value is actually R1,035,000 because that is the amount that the lessor is financing through this agreement. You will see I've made it a negative because in my mind, the lessor is getting rid of an asset by leasing it, and therefore it's an outflow of resources. The future value is the amount payable under the residual value guarantee, and there is no unguaranteed residual value. So the future value represents the residual value guarantee of R960,000. And then the payment is the fixed lease payment made of R75,000 twice a year. If you put all those amounts into your calculator, you then get an interest rate implicit in the lease of 13.43%. Requirement B asked us to calculate the initial measurement of the lease liability, and we know that the initial measurement of the lease liability is the present value of the lease liability, which is calculated from the perspective of the lessee. Now, once again, the lessee makes lease payments twice a year, and therefore we have to set our payments per year on the calculator to 2. Once we have done that, we can then go and fill in all the other variables. So N, once again, represents the non-cancellable lease term, which is 5 years, but we know that payments are made twice a year, so we take the 5 years times the payment per year. The future value represents the amount payable by the lessee at the end of the lease term. Now we know that the residual value guarantee is $960,000, okay? And we believe that the asset will have a fair value of $950,000 at the end of the year. So in other words, the lessor will get back an asset with a value of $950,000 and will also then receive a R10,000 payment from the lessee, because the lessee has to ensure that the lessor gets a total of $960,000 at the end of the day. That $960,000 can be made up of the fair value of the asset that the lessor gets back and cash. It could be just the fair value of the asset given back. It could be just cash, depending on the scenario. But in this case, we have a residual value guarantee of $960,000, and we know that the asset will be worth $950,000, and therefore the lessee just has to make a cash payment of $10,000 at the end of the lease term. Right, once again, the lessee will be making that payment, so it would be a negative. Then the payment represents the fixed lease payment made every 6 months, and that is R75,000. And the I we are going to use is the interest rate implicit in the lease because we could calculate it. That then gives us the present value of the lease liability to be R539,000, and that is after it has been rounded up to the nearest thousand. Requirement C asked us to calculate the initial measurement of the right-of-use asset, and therefore we know that we need to calculate the cost of the right-of-use asset. The starting point in order to get the cost of the right-of-use asset is the present value of the lease liability of 539,000 Rand, which was calculated in Requirement B. To that, we add any deposit paid. We know that a 50,000 Rand deposit was paid on the 1st of January 2010, therefore we have to add it. We then also know that costs were paid to the external legal advisor of 5,500 Rand. We add this because that is an initial direct cost of the lessee. And then we have an internal legal advisor. Now, you will see by the internal legal advisor, I do not have an amount. Nothing was added to the cost of my right-of-use asset for this internal legal advisor. And the reason for this is the internal legal advisor is on the payroll at the company. They perform work every single day at the company, and they are remunerated based on the work performed at the company. All right. So this internal legal advisor would have been paid by the company regardless of whether he advised on this lease contract or not. And because of that, because it was not an extra expense that the company had to incur in order to come to an agreement with this lease, therefore we cannot add it as an initial direct cost. That then means that the total cost of the right-of-use asset is 594,500 Rand. Requirement D has asked us to prepare the general journal entries for the period from the 1st of January 2010 until the 31st of December 2010. So in order to orientate ourselves, I've put all of the relevant information that we need in order to prepare these general journal entries on a timeline. I would really recommend using a timeline in any IFRS 16 question, especially when the lease payment date does not coincide with the year-end date. So you will see all the little purple marks, the light or the dark purple marks, I guess, those represent the year end, whereas the more pink marks represent payment dates. So we know that the commencement date of the lease is the 1st of January 2010. We know the first payment is made on the 30th of June 2010, and the last payment is made on the 31st of December 2010 for the period that we need to look at and journalize. But then we know that we have a year end on the 30th of April 2010. So now we have an issue because on the 30th of April 2010, we need to show that finance costs were incurred by the lessee, but we haven't yet made a lease payment. So what I do is on the 30th of June 2010, we know that we would need to make a lease payment. And this lease payment is made up of both interest and capital. So if you take your present value of your lease liability and you've now got the PV of 539,000. If you then go and say 1 input 1 shift amort, you can then get the interest and capital portions of the total lease payment of 75,000 Rand. If you do that, you will see that in the first payment, interest amounts to 36,194 Rand, while the capital amounts to 38,806 Rand. Now this interest of 36,194 Rand is the interest for a 6-month period from the 1st of January 2010 until the 30th of June 2010. So we know that 4 months of that period sit within the year ended 30 April 2010. So 4 of the 6 months of that interest relates to that year end, and therefore we need to prepare a journal. So if you take the full interest of 36,194 Rand, times it by 4 months, divided by 6 months, you get that the interest applicable to the year end 30 April 2010 is 24,129 Rand. Then additionally, we have interest of 2 months that will also need to be taken into account and journalized on the 30th of June 2010, and that is interest for the 2 months from the 1st of May 2010 until the 30th of June 2010. That represents the first payment. We then know that the second payment takes place on the 31st of December 2010, which is the last day that we need to journalize. So now there's no year end in between the 30th of June 2010 and the 31st of December 2010. Nothing else funny has happened, and therefore we do not have to split the interest. So if you once again take the PV of your lease liability of 539,000 Rand, and you say 2 input 2 shift amort, you can then see the split in that payment between the interest and the capital. So the interest amounts to 33,588 Rand and the capital amounts to 41,412 Rand. So this timeline just helps you to orientate yourself and to find out where exactly you are sitting on your timeline. What do you need to take into account where? So I would really recommend in any situation where your dates do not coincide, draw a timeline. And even if your dates do coincide, I would still go and draw a timeline. Now that we have looked at the timeline, we can now start preparing the general journal entries. So the first general journal entry that will be processed is on the commencement date of this lease on the 1st of January 2010. And on commencement date, we need to recognize a lease liability and right of use asset in the books of the lessee. So we know that the initial measurement of the lease liability is 539,000, and we know that that is the starting point for the cost of the right of use asset. So we will debit the right of use asset with 539,000, and we will credit the lease liability with 539,000. This makes sense because assets increase on the debit side and liabilities increase on the credit side. So that 539,000 represents the initial recognition of the right of use asset and the lease liability. But then we know that we add or deduct a whole lot of things from that present value of the lease liability in order to get the actual cost of the right of use asset. And we know when we calculated our cost that the cost of our asset or our right of use asset is not 539,000, it's 594,500. So we need to prepare a general journal entry to get the cost to be what it should be. So I debit my right of use asset because I want my right of use asset to increase, and I credit bank. Why? Because I paid the initial direct costs to the external legal advisor, and I paid the lease deposit of 50,000 Rand. So that means my bank has decreased by both of these amounts, and I have just lumped them together because the general journal entry is the exact same. And I have put through one amount of 55,500. You could do a separate journal entry for the initial direct costs of 5,500 and then a separate journal entry for the deposit paid of 50,000 Rand. I've just lumped it together because that's easier for me. I'm not repeating the same thing twice, and it just saves a little bit of time if this were a test. The next date that we need to pass journal entries is the 30th of April 2010, which is the end of the 2010 financial year. So first things first is we know that we want our financial statements to be a fair representation of the financial position that we are in at the end of the year. Now, if we do not go and show that finance costs were incurred for this period, but have not necessarily been paid, we would not be presenting our books fairly. So in order to have our books be a fair representation of what has actually happened at the year end 30 April 2010, we need to take into account that finance costs were incurred for this period. So here we debit our finance cost and we credit our lease liability, and that is the 24,129 Rand. That 24,129 Rand is the interest for the first period of 36,194 Rand times by 4 over 6 months, because 4 months fall into the financial year that we are looking at. Right. Once again, finance costs are debited because they are expenses, and expenses are generally debited, and we credit the lease liability because the principle in IFRS 16 says we take the present value of the lease liability, we add any interest, and then we deduct our full payment. And then, as always, at the end of a financial year, we have to calculate depreciation. We know that the right of use asset is depreciated at the end of each financial year on the straight line basis, and we will depreciate it over the period of the lease. Okay, so in order to get to that 39,633 Rand, we would take the cost of the right of use asset of 594,500 Rand, we would divide it by the 5 years lease period, and we would times it by 4 over 12, and that then gives us 39,633 Rand. That then brings us to the next date of 30 June 2010, and the 30 June 2010 represents the date that my first lease payment is actually paid. Now, once again, I need to take into account the fact that there is interest for another 2 months that need to be journalized, because I already journalized 4 months. Now I need to journalize the next 2 months. So I debit finance cost and I credit my lease liability. The amount is 12,065 Rand. How is this calculated? It is the 36,194 Rand interest, the total interest from the very first payment, and I times it by 2/12. Right, because only 2 months still need to be journalized. Then I need to take into account the actual lease payment made on the 30th of June 2010. Now, you are actually physically paying as the lessee, and therefore bank is decreasing, so we would credit bank with the 75,000 Rand, which is the lease payment, and we would debit the lease liability. So as you can see, the lease liability was increased by the interest, and now we are decreasing it by the full lease payment. But technically, what are you only deducting? You are only deducting the capital, because remember, the full interest is sitting in that 75,000 Rand. That then brings us to the 31st of December 2010, which is the second lease payment date. Now, once again, on payment date, we need to take into account that a portion of the 75,000 Rand represents interest, and this interest needs to be journalized and recorded as interest in the books of the lessee. So we debit the finance cost and we credit the lease liability with 33,588 Rand. How did I get that 33,588 Rand? Well, if you go back to the slide with the timeline, I got that 33,588 by taking the present value of the lease liability and on my financial calculator, taking 2, input 2, shift amort, and looking for the interest. Then I know that on the 31st of December 2010, I would have also physically made my second lease payment. Money would have left the lessee's bank account, so you would debit your lease liability, credit your bank with the 75,000 Rand. What is the net effect of recording the interest and then the final or the lease payment made? You are technically only deducting the capital portion of the lease payment from your lease liability. Requirement E did not have to be completed for the purposes of the assignment. However, in order to look at this question in its entirety, I will be taking a look at Requirement E. Now, Requirement E asked us to prepare the notes for the year ended 30 April 2010 relating to this lease. Now, the note relating to lease contracts in which the company is a lessee is generally Note 21 in financial statements, and this note is made up of many sub-notes, kind of. So 21.1 relates to the right of use asset, 21.2 relates to income expenses relating to the lease, and so it goes on. So the first one is 21.1, which is the right of use asset. Now, what's important is when you prepare the sub-note for the right of use asset relating to the lease, you need to tell us what type of asset are you leasing. And in this case, we are leasing a machine. At the beginning of the financial year, we did not have a lease yet because the lease only commenced on the first day of the financial year. Therefore, there was no carrying amount at the beginning of the year. But we have an addition of the cost of the right of use asset of 594,500 Rand. We then know that we depreciated the asset, and the depreciation amounted to 39,633 Rand, and that then led to a carrying amount on the 30th of April 2010 of 554,867 Rand. That is the right of use asset note. The next subnote is the incomes and expenses relating to leases. In this case, we only had expenses that were incurred during the current financial year, ended 30 April 2010. The first expense was the depreciation of 39,633 Rand, and then the second expense was the finance costs relating to the lease liability. Important, you need to state that it's the finance cost related to a lease liability because you could have finance costs related to loans and overdrafts and so on. So this finance cost amounted to the 24,129 Rand. The next subnote that we look at is the lease liabilities note. And with the lease liabilities note, this is actually a really nice note. You literally go and list the undiscounted cash flows for the lease liabilities that are outstanding at the end of the financial year. Now remember, on the 30th of April 2010, no lease payments had yet to be made. Alright, so that means the entire lease liability was outstanding. Alright, but now we're using undiscounted cash flows, so you're physically going to use that 75,000 Rand payment when calculating these amounts. So usually in a question, you will be given the time bands In this question, the time bands were not later than 1 year and later than 1 year, but not later than 5 years. So not later than 1 year means what payments are you going to make in the next 12 months, and you are going to make 2 lease payments, one on the 30th of June 2010 and one on the 31st of December 2010. So you take the 75,000 Rand and multiply it by 2, which gives us the 150,000 Rand. The next time band is later than 1 year, but not later than 5 years. Now, if we are making 2 lease payments in the next 12 months, and we know that 10 lease payments need to be made in total, that means that we are left with 8 lease payments that need to be taken into account within this time band. So that's why we have the 75,000 Rand times 8 payments. But we know that at the end of the lease term, we are going to have to pay cash in terms of the residual value guarantee of 10,000 Rand. That also needs to be taken into account, and that then gives us the amount of 610,000 Rand. The next subnote we look at just provides additional information. So here we give a little more information about the lease. What type of asset is it? Is there a residual value guarantee? Have we recognized a right of use asset and a lease liability? So under 21.4, there is a lease agreement for a panel beating machine. So I've been specific, for which a right of use asset and a lease liability has already been recognized. The right of use asset is subject to a residual value guarantee of 960,000 Rand. And then the last subnote needs to detail the cash outflow for leases for the year. So we paid the deposit of 50,000 Rand and we paid the initial direct costs of 5,500 Rand. That then brings us to the end of requirement E. The last thing that we need to discuss is the presentation and disclosure of the right of use asset and the corresponding lease liability in the Statement of Financial Position as at 30 April 2010. If we start with the right of use asset, we know that the right of use asset relates to this machinery that we are leasing. We are leasing the machinery for a period longer than 12 months, and therefore this right of use asset is classified as a non-current asset. The balance of 554,867 Rand is the same balance that we calculated in the right of use asset subnote of the lease contracts in which the company is a lessee note, note 21.1. We then move on to the lease liability. As it says in the name, the lease liability is a liability, but now the lease liability has a non-current portion and a current portion. The non-current portion represents the liability that will be paid over a period greater than 12 months, and the current liability portion represents the portion that will be payable within 12 months. If we start off with the current liabilities portion, the current liability portion of the lease liability amounts to 104,347 Rand. How did I get this? Well, in my first lease payment that is to be made on the 30th of June 2010, 2 months after year end, I will need to repay capital of 38,806 Rand. Because it will be paid within 2 months after year end, it is a current liability. The same with the second payment. The second lease payment is going to be made on the 31st of December 2010, which is 8 months after our year end, and therefore the capital portion that is going to be repaid through that lease payment of 41,412 Rand also represents a current liability. So as you can see from that little box, I have the capital portion of the first lease payment and the capital portion of the second lease payment. Importantly, to this I've added the interest of 24,129 Rand, which I have capitalized to my lease liability at the end of the financial year. The reason that it was capitalized is because it related to the period under review, and therefore, in order to fairly represent our financial statements, we had to account for this interest. And the interest was capitalized to the lease liability instead of being recognized as an accrued expense. However, this interest will also be taken into account and paid for in that first lease payment, and therefore it needs to be accounted for as a current portion of the lease liability. The only reason it has been taken into account is simply because we have already capitalized it. It is sitting in the balance, but it represents amounts that will be taken away from the lease liability in the next 12 months. We are going to repay it. Okay. it is sitting in the 75,000 Rand lease payment that we will make on the 30th of June 2020. That then brings us to the end of this explanation of the Rent&Dent Limited question. If you have any questions regarding the video or the question itself, please do not hesitate to contact us on frk201consult@gmail.com. Have a lovely afternoon and see you all soon.